Now let's talk about what BlackRock is actually building, because the Bitcoin ETF isn't the end game. It's phase one of a multi-phase strategy to dominate digital asset infrastructure. Larry Fink, BlackRock's CEO and founder, has been remarkably public about his views on crypto and blockchain technology since 2023. He called Bitcoin digital gold in multiple interviews. He said blockchain technology would fundamentally transform financial markets over the next decade. He predicted tokenization of real-world assets would be the next major wave of innovation in finance. These weren't offhand comments. These were strategic signals about where BlackRock was heading. Tokenization means taking real-world assets like stocks, bonds, real estate, commodities, and representing ownership through digital tokens on a blockchain. Every intermediary adds cost. Tokenized assets eliminate most intermediaries. Peer-to-peer transfers on a blockchain, direct ownership. Fees drop from dollars per transaction to pennies or less. Traditional securities have restricted access based on wealth and geography. Many investments require accredited investor status. Net worth over $1 million, excluding primary residence, or annual income over $200,000. Minimum investments of $100,000 or more for private equity, hedge funds, real estate partnerships. Tokenized assets can be fractionalized. Own 1/10 of a commercial real estate property. Own 1 share of a private equity fund. Own 0.01 Bitcoin. Democratized access to previously exclusive investments. BlackRock has been building this tokenization infrastructure quietly but systematically. In March 2024, they launched the BlackRock USD Institutional Digital Liquidity Fund, ticker symbol BUIDL. It's a tokenized money market fund built on the Ethereum blockchain. Institutional investors buy tokens representing shares in the fund. The tokens are programmable, instantly transferable globally 24/7, and can be used as collateral in decentralized finance applications. The fund invests in cash, treasury bills, and repurchase agreements. It yields approximately 5% annually, and it settles instantly. As of January 2026, BUIDL holds over $700 million in assets. Small by BlackRock's $10 trillion standard. But it's operational, functional, battle-tested, proving the model works at institutional scale. Now imagine a BlackRock-issued stablecoin launching in late 2026 or early 2027, fully backed by United States Treasury bills held at regulated custodians, yielding 4.5% distributed to holders, available through every broker, every wealth manager, every financial advisor that already distributes BlackRock funds, which is basically everyone. Institutions trust BlackRock more than they trust Circle or Tether or any crypto-native company. If BlackRock offers a stablecoin with institutional-grade custody, regulatory compliance, transparent auditing, and competitive yield, adoption will be massive and rapid. Pension funds can hold it, endowments can hold it, corporate treasuries can hold it, all with board approval and fiduciary comfort. That's the master plan. It proved the market had appetite. And now the infrastructure is being built systematically to capture the $6 trillion that Brian Moynihan sees leaving traditional banks. BlackRock isn't trying to build a crypto company. They're building the next generation of financial infrastructure. And they have the scale, trust, and distribution to actually pull it off where others have failed. These that adopt stablecoin treasury strategies early will have meaningful competitive advantages, lower capital costs, higher yields on cash reserves, instant settlement with global suppliers, automated treasury operations through programmable money. These efficiency gains compound. The financial system you'll interact with in 10 to 20 years will be fundamentally different from the system your parents used. Learning about digital assets, blockchain technology, decentralized finance, smart contracts, tokenization, these aren't optional curiosities. They're essential financial literacy for the coming decades, like learning to use the internet in 1995. Not everyone understood it then. Everyone uses it now. Digital assets are following the same adoption curve. Here's specifically what you should do. Start small. Open an account with a brokerage offering crypto exposure if you don't already have one. Allocate 1 to 5% of your investment portfolio to Bitcoin through ETFs like BlackRock's IBIT. Not because Bitcoin will definitely go up, but because portfolio theory suggests holding uncorrelated assets improves risk-adjusted returns over time. When yield-bearing stablecoins become available through your brokerage in Q1 2026, test them. Move a small amount, $1,000, $5,000. Understand how they work. See the yield accumulate. Verify you can move money in and out easily. Build confidence in the infrastructure before committing larger amounts. Don't over-allocate to any single innovation. Don't bet your entire net worth on crypto. This isn't about speculation or getting rich quick. This is about adapting to structural change in the financial system, the same way you adapted from cash to debit cards, from paper checks to online banking, from physical stock certificates to electronic brokerage accounts.